Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. It's an incredible time for retail investors. The economy is bouncing back from its first recession in 30 years. Interest rates are low. House prices are surging. Share markets around the globe are mostly back to pre-pandemic levels, and in some cases record highs. But investing isn't for the faint-hearted. For every buyer, there's a seller, and navigating which side of the transaction to be on isn't always that easy. Financial advice is a very valuable commodity, albeit one that fewer Australians are accessing. To help us make sense of the market this morning, I welcome Alex Jamieson from AJ Financial Planning. Alex, welcome to Fear and Greed.
Thanks so much. Really pleased to be here.
Now, before we get into the substantive stuff, what should a person think about when they're looking for a financial planner?
Well, really, you're wanting someone that has that impartial viewpoint. So the biggest issue or the biggest thing that's out there in the marketplace is we call it tied distribution schemes or tied distribution systems, where you walk into an advisor and you feel as though they're giving you advice in your best interest, but they've got murkiness around, alliances to product manufacturers or alliances around revenue targets. And so it's really that level of comfort. Hey, look, I'm looking at your position with a clean slate and I can really sort of properly consider most of the investment options that might be appropriate and strategies that might be appropriate to propel you forwards.
Okay, so if I'm going to a financial planner, just ask them whether they are tied or whether they are aligned to any product providers. Is that the best way to do that?
Yeah, it certainly is. Certainly when you're making that initial telephone call, looking at the licensee, if it's tied to a large financial company, gives you a little bit of an insight, or if they do have their own license, that can be an early sort of test as well. But certainly you just want to know, if you're walking into a Ford dealership, you know you're going to get sold a Ford. If you use that analogy, you want to make sure that you're not walking into a Ford dealership, that you're actually speaking to someone that can properly look at the marketplace and the strategies and make sure that they're presented to you to propel you forward.
It's just one of those things that I suppose I've got a bit of a bugbear about this. I think everyone should use a financial advisor. And I think some of the changes over the last few years has actually made it much more difficult for people to afford a financial advisor. And I think that's a real shame. I don't want to go down that path too much, but why do mum and dad investors need a financial advisor from your viewpoint?
I think it's that discipline in life around a lot of things for people. It's that continuity. So it's getting that grounding around a strategy that you're clear around to move you forwards, and then working with someone that's actually going to propel you forwards. You know, we often get told all the time, look, we should be exercising more and eating less and all those types of different things in our lives. Your finance is no different in a lot of regards. And just like those other aspects of your life, in doing it correctly, and you require some level of discipline. So that level of accountability and I guess really the realization of, hey, look, you may personally not know everything. And so these advisors can bring a tremendous amount of knowledge. And really the reason why I'm in this profession is it can make such a massive difference to people's outlooks and careers and their financial positions as well. Life is moving so fast, and those financial decisions that they have to make in rapid sort of moments for a lot of people can make massive differences longer term.
Okay, so let's jump into it. The idea of fear of missing out, messing with investment strategies, sort of making investors buy high and sell low. What's going on there?
Yeah, look, there's a wonderful little indicator that I often sort of refer to, particularly last year, given everything that happened with COVID and the markets and the like. And it's a CNN indicator. It's called the Fear and Greed indicator. And basically, if that indicator sort of shows the market is extremely fearful, quite often we find that the market does the completely opposite. Instead of falling, it actually turns around and increases. And when people get incredibly greedy on those indicator readings, the market plunges down. And so the main reason is people are hardwired in this sort of fight or flight response that we've got in the back of our head with that gland. And unfortunately, the response to run away from the lion is not the response that you have when it comes to investing. And so to some degree, you need to rewire yourself. And what we often find is people are chasing these last year returns. So give another example, the ARK ETF, which is a US ETF, did 150%. Now, years prior to that, there was not much in the way of returns. And if we look at what's happened the last couple of months, it's down negative 20%. So if you were chasing last year's returns, what you tend to find is you buy, in a lot of cases, very much at the top, and your brain hardwiring kicks in. You sell out when, in actual fact, you probably should be doing the opposite.
Is that more of a thing for retail investors?
I think so, because they're really easily rattled. So you've got tremendous amount of information sources, social media. You've obviously got mainstream media as well. And so particularly with last year, we saw when that really cranks up, people often, they either freeze or they may misstep. And most people feel that wealth needs to be sort of accumulated at a fast pace. In actual fact, what we find is if you've got a methodical, disciplined sort of approach around building wealth, making sensible decisions, your probability of success is far higher than if you're trying to chase the whims of the market.
That old saying, it's about time in the market rather than timing the market.
Yeah, certainly. I think if you're trying to day trade, your probability of success, if you're on the bell curve and you're middle, and most people think that they're not in the middle, about 7% more than a flip of a coin. And so your probabilities, and that's really one of the components with investing, is you're assessing probability of success, and you're looking at that and thinking, okay, I want to make sure that when I'm putting my hard-earned capital into these types of investment options, that I've got the tailwinds behind me rather than probability of a coin flip that I'm either going to win or lose.
Stay with me, Alex. We'll be back in a minute. I'm talking to Alex Jamieson from AJ Financial Planning. In Australia, the housing market is booming, undoubtedly. The share market's at 13-month highs or thereabouts. Is this a bubble that we're watching, and why are asset prices so high?
So we sort of think historically an average business cycle is on average about 8 to 12 years. And some economic theories sort of go out, look, we're just cycling through a boom and bust cycle. Historically, when we look at the landscape, we know when interest rates are ultra low, which is coming out of a recession, and people are spooked by the market, the first asset class that they race to is typically property. You can hug, feel it, pat it, feel good about it, and feel like it won't disappear, unlike sometimes like shares. And so it's not surprising. And then we also know that typically out of recessions, governments will juice the market with stimulus, and property is a good one to do that. It's easy to sort of give the bonuses for the new buyers. It's easy to sort of create the jobs with the building aspect. And so again, you've got a tremendous flock of people running. So what's transpiring at the moment is not all that surprising for me, and it's normally sort of well-trodden landscape. In terms of equities, well, I guess we know from academic studies when governments or central banks do what we call quantitative easing, which is printing money, it inflates growth-based assets. And we've seen those studies right around the world. Now, this is the first time Australia has done this sort of approach. We've seen in the US and Europe. And so you put interest rates at zero, and someone in retirement that has $1 million and you say, look, you can live off 10 grand a year on your $1 million. The commercial reality of someone accepting that is next to nix. And so they're basically, they're forced into the market to make hard decisions that they don't want to make. And that money goes somewhere. And at the moment, it's flowing into property and shares. So again, not all that surprising. Are we in a bubble? I don't think so, to be honest. I think when we look at the amount of stimulus, it's double what they spent on the GFC. When we look at the ultra low interest rates coupled with quantitative easing, it's not surprising. But are we seeing a tremendous amount of speculation? I would say yes. And that's probably more the concern around, as opposed to broad asset prices being generally overvalued.
So just explain that a little bit more to me. So what are we speculating on? Is it not blue chip stocks? Is it lower grade property? What do you mean?
Yes, you've had these tremendous technological advancements. We've got trading platforms like Robinhood, where you've got digitized this idea around investing. And so you sort of think about your social media platforms and you think, well, how often do I check Instagram or other social media platforms? Now you've got guys that are programming these trading platforms like Robinhood with the same sort of trying to hook you into it in that regards to get your trade. So I'll give you an example. There was a great piece in the Wall Street Journal. They interviewed a gentleman who said, look, I looked at my Tesla share price 18,000 times during 2020. And so you go, gosh, you're getting that dopamine hook in there. And so then you sort of layer on this fact that most people are at home, working from home, and also they're being given stimulus checks. We sort of thought about when the baby bonuses first came out. I'm 45. When they first came out, everyone bought plasma TVs. A lot of people have taken that cash and effectively put that into the share market. So we're certainly seeing these really huge amounts of risk being taken on these hot investment innovative ideas. And I guess, there's definitely some concern in that area. And that's only going to get worse around that gamification of people's investment strategies.
We'll be back with more in a moment. My guest this morning is Alex Jamieson from AJ Financial Planning. And then in the housing market, people taking on bigger and bigger loans because of the low interest rates. I suppose the question is whether or not when rates rebound, and they will, that people can afford to pay 2 or 3 or 4 or 5% higher interest rates.
Yeah, definitely. So we know the market's starting to price in interest rates from year 2 onwards. The RBA has been out there very vocal about, look, we're not going to make any changes until year 2. We also know historically that the RBA or a central bank needs about 2 to 3% to handle any downturn. And so we think back about that comment earlier that I made around the business cycle being 8 to 12 years on average. They need to have that saved away that they can handle the next downturn. Otherwise, they're in a difficult position. And so we sort of see at the moment the bond market is pricing in just a little bit under 2% in rises over that next cycle. But the problem with that is the more people take on, the more sensitive. So the ABC news station has this wonderful piece of data where you plug in. Now, I live in Bayside in Victoria, and a 1% increase in mortgage rates there. That will mean that the suburb that I live in, which is Beaumaris, mortgage stress starts about to enter in for about 27% of that population base in that suburb. Whereas if you go over to somewhere like Geelong West, you go as high as 76% for a 1% move. And so, yeah, I think certainly that's probably the biggest issue for property in that year 3 when we start to see those increases in interest rates. We've got a whole lot of people that believe that this is what interest rates will be for the next 25, 30 years, and that might not be the case.
I suppose when you've had interest rates so low for so long, you forget what it could be like.
Yeah, I think what part of the dangers around that, if we sort of cast our mind over to places like Japan, where they've had really long periods of time of low interest rates, is you do get quite range bound. And so essentially, because people are able to rack up so much debt, they only need to move it a little bit to sort of have a meaningful impact. And so I guess the longer we sort of spend at these sort of low levels, yeah, certainly it means that we do increase the likelihood which we stay, which is fine for someone that's borrowing. But if we sort of, again, look at the other side, which is the investors that are in that fixed interest space, it does place tremendous amount of pressure. And there's a lot of social sort of questions being raised about the equality of it. Are we favouring one group of the population over the other and disadvantage one group against the other? So we're going to see that political conversation increase dramatically over the next few years.
It's going to be interesting. Alex, thanks for talking to Fear and Greed.
Not a problem. Thanks for having me.
That was Alex Jamieson from AJ Financial Planning.